All right, so there are a lot of definitions in this chapter, and you need to pay particular attention to these. But the great thing about these definitions, for this section anyway, is that they're not anything new. All right, so amount realized, okay, is your cash received plus the fair market value of other property. Pay attention to that. All right, plus whatever liabilities are being assumed minus expenses. Okay, that's pretty straightforward. Also, adjusted basis. Okay, so adjusted basis for tax purposes is very similar definitionally, if that's a word, to adjusted basis for financial accounting purposes, even though the actual amounts might not be the same. Okay, now this is an interesting portion of the definition. The cost recovery allowed or allowable. All right, for IRS purposes, if you are allowed to take depreciation, but you do not, it is still assumed that that depreciation that you were allowed to take would decrease the basis of your asset. Now, an exception to this is if you elect out of bonus depreciation, then it's not assumed that you could have taken that. So let me write that down. If you can take depreciation and you do not elect out, then it is assumed that you did take depreciation, and the Internal Revenue Code requires that you adjust your basis. Okay, so even if you don't actually take the depreciation, if you do not officially elect out of taking the depreciation, then you have to reduce your basis. And what will that mean? Well, if you have to reduce your basis, then you're potentially lessening your loss or increasing your gain. Either way, from a tax perspective, that's a negative result. Okay. Realized gain or loss. Okay, so amount realized minus adjusted basis. That is not a new definition for us. We've dealt with that before. Okay. This next slide just combines all of those definitions essentially into one slide. So it's kind of handy, but we're going to move on. Because now we're getting into kind of some different situations for determining adjusted basis, okay? When you purchase an asset, determining adjusted basis is pretty straightforward, and we've already talked about that. All of the things that go into calculating your basis, that was chapter 10. But what if you receive something as a gift, okay? So two situations. If, as of the date of gift, the fair market value is of whatever you were given is greater than the donor's basis, then the donee's basis is carryover basis, all right? And then if at the date of gift, fair market value of the asset is less than the donor's basis, then you have to look at when this asset was sold, all right? So I think the best way to look at this is to do an example, all right? So let's do an example. So let's say Grandma gives you one share, just for simplicity's sake, of Google stock for graduation on May 14th, 2020. All right? So you've got one share of Google stock. Now, the question is, what is your basis in that stock? Okay? Well, the answer, because this is tax, is it depends. All right? So let's look at two different scenarios. Okay? So, hold on though. Let's say she purchased the stock when it IPO'd in 2004 and Google IPO'd for about $85 a share. Okay? All right? She gives you the stock on May 14th, 2020. All right? So that's all kind of our given information. Okay? So scenario 1. All right? Assume fair market value of Google on May 14th is $1,276. And that's right, that is what Google stock is trading at today as I'm doing this. So it's $1,200 and change per share. Okay? So if that is the fair market value of the Google stock on May 14th, all right, then what is your basis? Then your basis is $85, which is called carryover basis, because that was the basis that your grandma had. So you get carryover basis because fair market value at the date of the gift is greater than the donor's basis. Okay? So your basis is the carryover basis, and this stock is a long-term asset, even if you sell it on May 15th. So even if you sold it the next day, you would get long-term treatment for that stock because you have carryover basis. All right, but so let's do scenario 2 now. All right, so we're going to move things up a bit. And then for scenario number 2, oops, I can't write today. Assume fair market value of Google on May 14th is $80. All right, so if we make that assumption, now your basis depends on the fair market value of the stock when you sell it. All right, so because now on the date of the gift, the fair market value of this stock is less than your grandma's basis, you now have to pay attention, and your basis in the stock depends on the fair market value when you sell it. So if when you sell the stock, the fair market value is greater than $85, then you get carryover basis, and it's a long-term asset. All right? If the fair market value is less than $85 when you sell it, then your basis is the fair market value on the date of the gift. So that was $80. And your holding period is based on the date of the gift. So May 14th. Okay? So you've got two different scenarios now. And I'll make that one big enough so you can see it all on the screen there. Okay? So two different scenarios. So when you're talking about property that was gifted, you have to pay attention to the fair market value of the property as of the date of the gift, all right, in order to determine your basis. All right, with inherited property, the determination of basis is a whole lot easier. Your basis in property you would receive via someone else's death is based on the fair market value as of the date of death, or an alternate valuation date that you would pick at most 6 months after the date of death. Okay? If you pick an alternate valuation date, all of the assets have to be appraised and valued as of that alternate valuation date. Okay? So now let's talk about when you convert property from personal use to business use. Okay? So say my Jeep that I drive around and is personal use property. What if I started a landscaping business and now I was using that Jeep to pull a trailer with landscaping equipment, and it became a business vehicle? All right. So then my basis depends on when that property was converted to business use, whether the property had declined in value or appreciated in value. Okay. If it appreciates, then you use the basis. What did that Jeep cost me when I bought it new? All right. If it had declined in value, which cars, as soon as you drive them off the lot, they've declined in value, then you use the fair market value as of the date of the conversion for calculating the loss. Okay. So that one's pretty straightforward. All right. Now let's do two quick examples, and then we're done with part 1 of chapter 11. All right, so we've got this company, Scrap Happy, and they own a computer, which is 5 years maker's property, okay? And they purchased it 2 years ago for $1,200. And for financial purposes, they use 3-year straight line depreciation, all right? No salvage value. So we're just looking at the difference between book value basis and tax basis, all right, after those 2 years of depreciation, okay? because even though you pay the same amount upfront for book purposes and tax purposes, so initial basis will be the same, your adjusted basis over the years is going to end up being different. Okay, so I'm going to change color here. So we'll just make a little chart. So initial basis, and then we've got book, and we've got tax, okay? So we purchased this thing for $1,200. So our initial basis for book and tax both are $200, all right? So our first bit of depreciation via straight line for half a year is $200. For second year depreciation, whoops, not 4,000. I got a little carried away with my zeros there. It's $400. Whoops. Okay, and so then our adjusted basis after 2 years of depreciation is $600. Okay, so now what do we find for tax purposes? Well, we got to go to the maker's tables, and if we go to the maker's tables, we end up with $240 of depreciation for our first year and $384 of maker's depreciation. For the end of year 2, which leaves us with an adjusted basis that is lower for tax purposes than for book purposes. Okay, now that's fine, right? It doesn't really matter until we go to sell that asset. All right, so let's say, okay, I'm going to move all that up. Let's say that we sell the computer for $400. Okay? All right. What is our gain or loss? Oops, I need to move up a little bit. Okay, so again, we've got book and we've got tax. All right. So from a book perspective, what was our amount realized? Whoops. $400. Our adjusted basis is $600. Oops, I gotta move up. So our loss is $200. Okay, now for tax purposes, our amount realized was still $400. But our adjusted basis in this situation was $576. So our tax loss is $176. Okay, so whenever we end up with these book tax differences, this is going to be a book tax difference on our tax return if we're a corporation. All right, so the whole point of this is you may not have the same adjusted basis for book and tax purposes, which is going to lead to different amounts of gain or loss for book and tax. Okay, So your taxable income and your financial income are not, in most situations, are not going to be equal. All right, that is all of chapter 11, part 1. Bye.